Today we're going to be learning a few things that are quite useful and important for security analysis, and that is estimating beta and understanding the capital asset pricing model, also known as CAPM. As a financial consultant firm, we will share one of many processes that help our clients understand their investments better and make informed decisions, and hopefully will help you too. Before we start, we'll confirm that the client profiles in this video are for educational purposes only and are theoretical. Let's talk about Tommy's situation. Tommy here wishes to make his first investment of $1,000 into a single stock and seeks financial advice. He would like to minimize as much risk or volatility but maximize the yield on his long-term investment. Sometimes this may be feasible, sometimes not. In his interest, we'll be focusing on BHP, CBA, and Qantas. Volatility, as we all know, comes in different methods and definitions, but today we will be focusing on the more simple form of volatility. We can call this rolling volatility or simple historical volatility, measured with a statistic called beta. And what beta essentially is an estimate of volatility an asset has to the market. One meaning the security's price tends to move with the market, and more than one being that it is more volatile than the market. And to do this, we will need to compare the selected stocks to a market proxy. So for this analysis, I'll be using the ASX 200. The first thing we need is sufficient data of the stock's historical prices, which can be found on many online sources. But for this example, I'll be using Yahoo Finance. We want to be as recent as possible, so I'll be using the horizon from the 1st January 2018 to the 1st of July 2023. I'll actually put in a month before the dates we want to do, and I'll tell you why later in the video. We'll be analyzing the monthly data, so go ahead and apply it. It should look something like this. Download it and load it onto an Excel spreadsheet. This is the column we're going to use, and what adjusting closing prices are is that it takes into account the stock price of any splits and dividend distributions and gives a more accurate idea of the stock's fair value. We'll go ahead and delete all the unnecessary columns and just keep the adjusting closing prices. Now we need to find the price changes for each month. To do this, we'll just take the price of this day minus the price for the previous day divided by the price of the previous day. And that gives us the price change from this month to the next. And the reason why we're doing December 2017 price is to calculate the price change for the start of January 2018. So we have a fresh date full of monthly changing prices. So be mindful of the dates that you choose. Now just drag this down to give us a spectrum of price changes and do the same for the rest of the data, CBA, Qantas, and the market proxy. And I've just compiled all of the monthly changes of returns into a single spreadsheet and added the guidelines of what I'm going to be walking you through. For the first method of calculating beta, we need to calculate the variance and the covariance of the stock price. For variance, we'll be using the var.s formula, which is just the variance using the sample data, and input the prices for the corresponding stock, which we'll be starting with the market proxy. Let's drag it over automatically to fill the rest. Another important piece of information that we might want to know is the standard deviation of the stock prices, and what this tells us is how widely dispersed the trading prices are from the average prices. And this is also an indicator of volatility. I'll show you two methods. The first method is square rooting the variance that we calculated above. The second method is using the stdiv.s function, which is just the standard deviation of the sample prices, and we'll import the stock prices of the corresponding stock. We'll drag it over, and as you can see, it is the same values as above. We have just computed the same values but use different methods. The standard deviation of Qantas is 0.10156, which is fairly high compared to the other stocks. This just means that the average price of Qantas is 0.1 10156 standard deviations away from the average price of the market, which means Qantas would be a little bit more volatile than the rest of the stocks. The next is covariance. I'll just be using the covariance.s function, which is the covariance of the sample prices, to calculate the covariance between the stock and the market proxy. What this tells us is the relationship between the two variables in terms of movement. If one goes up, one might go down, or if one goes up, then the other one also might go up. And the covariance is just a measure of that relationship. I'll just be locking in the first array since I want to compare all of the stocks to the market proxy, which is the ASX 200. And now we have all the variables to calculate our beta values for the first method. We can input in this cell the covariance of the ASX 200 divided by the variance of the ASX 200. And we get 1. Why is it 1? Because when we compare our market proxy to the default market movements, then it is simply 1. This means perfect correlation, so the beta will be 1. So we'll just drag it across to produce this beautiful spectrum of betas, and as we can already see, BHP has the lowest beta compared to Qantas and CBA. Qantas has the highest beta of 1.3824, meaning that it will be slightly more volatile than the market. For the second method of calculating beta, we'll be using the slope Excel function, and all we need to do is input the Y values as the stock and the X values as the market proxy. So here I'll just be locking in the market proxy cell in the X range and dragging it across. And as you can see, they are exactly the same as the previous beta calculated. Moving on to the last method of calculating beta. This will be through regression analysis. We'll head to the Data tab and then Data Analysis. Just make sure you already have the Analysis Toolpack ticked and downloaded. Press Regression over here. For the Y range, it will be the stock return, and for the X range, it's going to be the market return. It's a bit low, let's put it a little bit up. Doesn't work. Let's try again. Yep, there you go. So what we see here is the regression analysis for BHP and the ASX 200. This right here is our X variable, which is our beta. Let's just highlight it so it's a little bit clearer, and as you can see, it is exactly the same value as the betas we calculated previously in our two methods. I'll show you one more time how to do it for the other stock. Just head back onto the Data tab, Data Analysis, Regression, and then highlight the stock price, which is for the CBA, and the market price for the ASX 200. We'll make sure we change our cell range so it's where we want it to be. And there you go. That's a summary output for CBA and the ASX 200. I'll just quickly finish up for Qantas and we'll show you what it looks like.
1 hour later. Two hours later. 3 hours later.
Can you move it along? I'm all out of time, Con.
Once again, all the betas in the regression analysis turn out to be the same as the betas calculated using the slope and the covariance function. But just be mindful when using the regression tool, make sure that you input the correct X and Y range, otherwise it will give you a different answer other than your beta. And there we have it, our betas in 3 methods. Let's move on to the CAPM model, a more fun theory. This model basically tells us the rate of return an investor would make on an investment for a given level of risk over a specified holding period or just depending on the data that is used. In this case, in Tommy's case, since we're using monthly historical prices, let's say we calculated the expected rate of return to be 5% for stock XYZ. This means that the average return Tommy would expect to earn on a monthly basis would be 5%, Although it is only an estimate and a theoretical figure, financial consultants, investors, and stock analysts such as myself often use such models to assess risk and return to make investment decisions for clients or investors themselves. The risk-free rate of interest is the theoretical rate of return of an investment with zero risk. It's basically the rate of return an investor can expect from an investment that virtually has no risk or loss of principal, which is technically impossible in this world. For simplicity, we're going to assume a monthly risk-free rate of 2%, but can be further calculated through taking the average of yields of the treasury bills from the denoted period. We can calculate what Tommy should expect to earn on his investment by using the CAPM equation over here. But first, we need to figure out the expected monthly market return, which is the ERM. We just take the average of the market indice and there you go, 0.41%. Next, we just need the betas of our stocks. So we'll just grab it from a previous spreadsheet and I'll just drag it across. And now we have everything we need to calculate our return on each investment stock. So we just need to do everything that is pictured in the CAPM equation. That's just the risk-free rate plus the beta of the stock times the market return minus the risk-free rate. And there you have it. That is 0.388% return on BHP. I'll just lock in the constant, so that's everything except the beta value. So the constant will be the risk-free rate, the market return, and then the risk-free rate again. And when I drag it across, it will give us all these beautiful monthly returns on each stock. Let's just note that Qantas has the highest beta but also the lowest return, and BHP has the lowest beta and the highest return. Let me just highlight this to make it a little bit more clear. So in summary, what we have calculated so far are these yields, and that these yields take into consideration the risks involved with each stock. That's why the beta is in the calculation. So when we do the stock analysis for any other stock of your choosing, we will be getting a clear idea of the opportunity cost that sometimes there will be low returns with low risks and higher returns with higher risks, vice versa. It all depends on the investor's preference. So we can all come to a conclusion to say that the best option for Tommy would be to invest in BHP. Number one, it had the lowest volatility to the market from 2018 to 2023 with a beta of 1.014. Number two, it has the highest yield of 0.388% on a monthly basis. On the other hand, Qantas was not performing so well these past few years, nor will be within the next few years. It had a beta of 1.382, but also had a negative yield of 1.98%. Again, this video is for educational purposes only as per the results. Please do not apply the results to the real world and instead use the methods to educate yourself. Before making any uninformed decisions, please consult your financial advisor so you get the best possibility for yourself. Well, that is all for today's video. I hope you learned something interesting or useful you can apply to your future investments.